Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is Your Money, Your Wealth.
Hey, and welcome back to another edition of Your Money, Your Wealth. Joe Anderson here, certified financial planner and president of Pure Financial Advisors. As always, the big man sitting right over there. So we've been talking taxes the last several weeks, and I begged Alan Clopine not to talk about taxes, and guess what? We're talking taxes again one more time. We got a couple more weeks left to do some things to significantly save some money in taxes. Now, most of your CPAs that you go to at the end of the year, they might save you a couple of bucks or maybe $1,000. We'll get into those strategies. If you want to save $1,000, that's great. How about if you want to save $10,000, maybe $50,000 or even more? We'll get into more complex strategies later on in the show. That is what's on my mind today. All right, let's get into it, because if you look, there's still a couple weeks left before the end of the year, and there's still things that you can potentially do. Because what's one of the best gifts that you can give to yourself is save a little bit of money in taxes. So to help start the show off right, let's get started right away and bring in Mr. Alan Clopine. All right, man, this is your show.
It's pretty exciting.
End of year taxes.
I think this might be, about the 10th show we've done in a row on taxes?
You know, but it's important.
It is important.
Right? For you and I, we live and breathe this.
Yes.
But for most individuals, they don't really understand the tax code or what they can potentially do to save a couple of bucks. And so let's dive in, and what are some strategies that people should use? Yeah,
let's jump right in, because here's the thing. You got to act by December 31st. That's why we're doing these tax shows right now, because most of the strategies that are available need to be implemented right now, between now and year end. So today we're going to talk about how to save $1,000, how to save $10,000, how about $50,000. Is that interesting? I think so. Let's get into that, Joe, because people need to know how to save money on their taxes.
Yeah, I think some of the common things that most CPAs do, no offense, you're a CPA, you've been a CPA for quite some time, is that end of year there's some things, bunching expenses, taking a look at some...
Yeah. Are you putting my profession down?
Absolutely not. I love you, buddy.
Okay.
CPAs are a very important part of our society.
All right.
Because I'm a big believer...
But you're saying some of the suggestions are they save you a couple nickels.
Well, no, I read the Wall Street Journal, last week, and it was a huge article of saying, here's all these strategies that you can do to put so much more money back in your pocket, and you read the strategies, and it might save you a couple $100.
Right.
So I think it's overhyped a little bit, because they don't want to necessarily get too complex. So let's start simple, and then let's just kind of dive in a little bit deeper as we go.
All right, well, good. Let's get into how you save $1,000 right from there. I mean, who doesn't want to save at least $1,000? So right off the bat, I would say this. If you have a security, a stock, mutual fund, bond that is in a loss position, in other words, you bought it for higher than it is right now, you can sell it at a loss and create a deduction that way. How about prepaying your January mortgage statement or your April property taxes in December? And if you're a business owner, you could buy equipment to create a quick deduction. All of these things have to be done by December 31st. So why don't we get into some examples right here? Let's go right off the bat as far as selling a security at a loss.
So, I guess let's define what a security is.
Yeah.
So a security could be a stock, bond, mutual fund, anything that you hold outside of a retirement account.
Right.
So if those assets go down, you could potentially sell them, and then there's a tax benefit that goes along with that. So let's go into the example to take a look and say, all right, well, if I bought a security and then I have a loss, how can that save me money? Yeah,
so here we go. You have a security, it's worth $4,000, but unfortunately you bought it for $7,000. So if you sold it today, you got a $3,000 loss on sale. Now, an interesting thing about securities, that's a capital loss, and capital losses are generally only deductible against capital gains. But in this case, the IRS lets you deduct up to $3,000 against ordinary income. Let's say your federal and state tax rate collectively is 33%. A $3,000 loss causes you to save $1,000. $1,000.
Well, all right, so here's a misconception, too, with this type of planning. When we look at tax loss harvesting, and we've talked about this on the show before, but if this is the first time viewing, here it is. So if I have securities that are down, we tell our clients and our viewers and our listeners to take a look in selling those positions. So let's say you bought the asset for $10,000, and now it's worth $5,000. We would encourage you to sell that asset and buy something similar to harvest those losses. Of course, worse if it's outside of your retirement account. If you continue to harvest those losses, let's say you have $10,000, $20,000, $30,000 of collective capital losses on your tax return, most people think that the only tax benefit is the $3,000, and that's not true, because if I have any other gains, those gains would offset those losses dollar for dollar. So it's significantly higher than the $3,000. But if I don't have any gains that year, then I can then write off the $3,000 off of whatever capital loss I have to get that $1,000 benefit.
That's exactly right. And we're really not telling you to try to lose money. It's just what happens with securities.
Well, yeah, stocks are risky, right?
Yeah.
Stocks go up, stocks go down. And so when you look at if the market goes down, which it does, you just want to capitalize on it. You want to make sure that you're using your investments tax efficiently to make the most out of your money.
Yeah, and so when you sell this position, maybe it's mutual fund A, go ahead and buy mutual fund B at the same time. So you're still in the market, but you create that loss. All right, let's get into the second way to save $1,000, and that would be prepaying your mortgage payment, prepaying your property taxes. So here's a real simple example. Let's just say your mortgage payment's $1,000. Let's say it's interest only, $1,000 of interest. Your April property taxes, April next year, would be $2,000. You can pay both of those in December and have them be fully deductible. Add those up together, $3,000. That adds to your itemized deductions. 33% tax rate between federal and state. Here you go again. It's a quick way to save $1,000. Now, of course, you're borrowing into next year because you're going to have less deductions next year, but at least if you need it this year, if you're higher tax bracket.
Yeah, if you have higher income this year, then that's when you want to do it. But if you have the same income, what you're doing is you're stealing Peter to pay Paul.
Yeah, exactly.
Right? Because you're not going to have those deductions next year, so potentially next year you're going to have a higher tax bill.
Yes, you are. Yeah, so be aware of that.
So I mean, it's a shell game.
Yeah.
So if you have higher income next year, don't do that strategy. If you have lower income next year, then absolutely you want to use that strategy.
Yeah, absolutely. Okay, so let's get into another one. So for our business owners, you can actually buy equipment by year end, and this year it's called Section 179. You can actually buy equipment up to $25,000 and write it off dollar for dollar. So very simple example. Between now and year end, you know what? You need a new computer, you need a new printer, you buy it, you get it set up by December 31st, costs you $3,000. How much is deductible? Well, it's less than that $25,000. It's all fully deductible. $3,000, 33% tax rate, so $1,000 in tax savings. Now, if you need other equipment, you can actually buy up to that $25,000. And be aware of this, is last year that Section 179 limit was $500,000, and they may actually extend that retroactively. We don't know that yet, but we'll have to wait and see. But at least we have $25,000 for this year.
25 grand. So if you want to look at, if you're looking at buying equipment for your business, that will give you a significant write-off. $500,000 in the last couple of years was pretty significant.
It was a lot. But I would tell you this: don't just buy equipment for a write-off. Only buy it if you really need it. Because if you're in a 33% tax bracket buying a piece of equipment, you spend $1 to save 33 cents. It doesn't necessarily make a lot of sense. But if you need it anyway, go ahead and do it.
Hey, stick around. We got to take a short break, but when we come back, we're going to get into a little bit more advanced strategies. Most of you have probably already done this in the past, what we've just went through, but now let's get a little bit more complex. How can we save a little bit more money? Can I save $10,000, $15,000, $20,000? Then we'll get into even more complex and say, how can you save $50,000, maybe over 50 to 100 grand? How about that? Don't go anywhere. Show's called Your Money, Your Wealth. We'll be right back.
Is it really worth delaying collecting your Social Security until age 70?
You know, that's a common question. Welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine. A lot of questions come up with Social Security right now because it's a huge topic. There's a lot of baby boomers that are turning 65 and they have to make this decision. And so if you look today, if you wait each year after you turn full retirement age, or actually when you can start collecting at age 62, but if you wait until age 70, you get an 8% increase on your benefit each and every year. So it's a very difficult question to answer without knowing more specifics. Ideally, if you're single and if you're still working, of course you want to extend that thing out as long as you can because that's going to give you an 8% increase. But if you have short life expectancy, then of course you don't necessarily want to extend it, right? So it's a bet to live strategy. If you have very long life expectancy, the longer you wait, the more money that you're going to have. If you take it at full retirement age, right, you get your benefit earlier, right? But it's a lower benefit. So the break-even point or the crossover point on that, depending on if you take it at 62, 66, or age 70. So if I take it from 62 to 70, so let's say I take it right away, I think that the crossover, the break-even, is roughly age 80, something like that.
Something like that. Yeah.
So if you're going to live past age 80, then it makes sense to push this thing off. So it really depends. It depends on what other income sources that you have. But in most cases, it's going to make the most sense to push it off because 8% is a ton of money, and it's going to be guaranteed by the federal government.
Yeah, I agree with that, and especially considering that the life expectancy tables that Social Security ran were way back in the 1980s, and now we're living longer. So it actually does pay to wait as long as you're in reasonable health. So I mean that's pretty big key.
Hey, let's go to the true-false question.
Medical expenses, including health insurance premiums, are fully deductible on your tax return as itemized deductions. And the answer to that is false because there are limitations. And here's the limitation is you have to take your gross income, adjusted gross income, which is at the bottom of your first page of 1040 tax return. And you have to take 10% of that, and you can only deduct the amount that's over that. So like your health insurance, your medical costs that you're paying, it has to be over 10% of your income.
So if your adjusted gross income is $10,000, your medical expenses are $100,000, it needs to be over 10 grand.
Yeah, that's a good way to say
and
it.
Yeah, so anything under $10,000, you're not going to be able to write off. Now, if you are over, 60, then it's still 7.5%?
Yeah, it's 65 actually.
65.
If either you or your spouse are over 65, it's 7.5% of adjusted gross income. So you may get some benefit from medical, but in many cases you don't. You don't have enough income to be able to claim it.
All right, let's get into some other strategies that can save you a little bit more money than just a couple of thousand. All right, so gifting to a donor-advised fund. This is a very cool strategy. Al's going to write this out on the whiteboard. But also, if you're a business owner, you can get into a solo 401k. Most small business owners go into a SEP IRA or maybe a simple IRA. And then also, here's a really interesting topic we can get into. So should I get married just for the tax benefit, or should I stay single just for the tax benefit? We get this question quite a bit. It's like, all right, well, here, should I get married? If I get married, am I going to pay more in tax? Well, first of all, marriage should be based on love and happiness.
It should.
It shouldn't necessarily have to do
but we do get asked that. We get asked that question all the time.
That you pay in taxes.
Yeah.
Al, I got to ask you a question before you go in here.
Okay.
Did you know it's never wise to invest your money in Alaska?
You know, I just heard that. Why is that?
Because they might freeze your assets. That's from Danny, our cameraman.
We don't have any good sound effects on that, but it's a great joke. It's a great joke.
Yeah, we thought it was hilarious. I think most people are just looking at me like, well, what the hell is he just talking about?
Oh, well,
Or
let's
what's
get into content now.
All right. Go for it.
So,
Donor advised fund. Tell me what
here we go. Well,
what is that all about?
Yeah, we're talking about ways to save like $10,000 or more. So this is a pretty cool idea, right? Which is and here's the concept is, wouldn't it be nice if there was a way to deduct future year contributions into this year's tax return? And the answer is you actually can do that. You just have to set up a special kind of account called a donor advised fund. And let me illustrate. So you set up this account, and you can set up this account at, I'll call it donor advised fund. You can set it up at TD Ameritrade, you could set it up Fidelity, at Schwab, doesn't really matter. You set up this account, you take some of your dollars, and you put it in the account. So now your money's sitting in the account. Now this is a one-way street, and it is designated for charity in the future, so be careful, don't put too much in. But here's the concept. The year that you put the money in is the year you get a tax deduction right on your tax return. It doesn't mean the charity gets those amounts. You get to decide what charities get what amounts later on. So you're in charge of this account. You're the trustee. You get to decide how it's invested, and y'all get to decide what charities get what amounts in the future. Like, let's say 2016, you want to give charities this amount, 2017, 2018, or you could just let it grow if you want to. You don't have to distribute. But the point here is that you could end up taking a big tax deduction for future year contributions. And if you're in a big tax bracket, it's actually a pretty good deal.
So if you take a look at your taxes right now, so you're saying, hey, I want to try to create a larger deduction, and you're already giving to charity, church, or whatever that you're giving to, and maybe you're giving $5,000, $10,000 a year, and you're in a large tax bracket this year, maybe because of stock options, maybe you got a large bonus, maybe you got a business buyout, whatever the case may be, you can bunch those charitable gifts all in 1 year. So it's a very, very cool thing from a tax perspective, and also still that you're going to give to your local charities, but you get the large tax deduction this year. So if you are in a large income this year, this is something that you absolutely want to consider. Now, let's go into small business owners.
Yeah,
so when you're looking at retirement plans, there's a lot of different options there as well.
Yeah, so you have the opportunity to set up a retirement plan as a small business owner, and really the best one, if you don't have employees, would be called a solo 401k or an individual 401k. So you're allowed to set up your own private 401k, and here's a quick example. Let's say you have business profits of $50,000. You set up this solo 401k, you actually get to defer up to almost $33,000. Look at this, $33,000 at a 33% tax bracket. You're saving over $10,000 just from this one strategy. That's with just $50,000 of business profits. If you have higher profits, it could be even more. Now contrast that with a SEP IRA, which is what most other people do, and think about, you can only put away about $10,000 for a SEP IRA. So a solo 401k is a lot better way to go if you don't have employees. You have to set that plan up by December 31st, but you can actually fund it, put the money in the plan all the way to the due date of the tax return, which is April 15th as a sole proprietor, or if you extend the return, it would be October 15th of next year.
So a couple of different thoughts here is that, all right, if I have a large income, maybe a spouse has a small business, maybe consulting, doing whatever. You look at a donor advised fund, you can bunch up some expenses right there. That's real quick and easy to do. And then you can set up this solo 401k plan before year end, and then you can fund it. So you can save significant amount of money with just two simple quick moves here. Let's get into the final one. Should I get married, Al, to save money in taxes, or should I stay a single man the rest of my life?
Well, let's go over an example. Here's maybe it's an extreme example, but it will give you an idea of.
No, that looks very similar to me. Right? Jennifer, my wife,
your wife makes 500. Yeah, your wife.
She's making 500 grand.
Yeah,
and I'm going to quit my job and make nothing.
Yeah, I changed the name from Joe to Tom. So you make zero. Total income 500,000. Look at this. Single taxes, if you add them both together, 155,000. Married taxes is about 145,000. You would save $10,000 from filing married. So here's an example where married actually is better than filing single. Now, it flips completely around. If both husband and wife are making relatively similar amounts, then you're actually probably going to pay more taxes married versus single. So when it comes to taxes, you have to do some tax projections to figure this out. And believe it or not, we get asked this question all the time. Should I get married this year or next year? And so the answer is it depends.
Right. And now if you take a look at some Social Security benefit strategies, such as spousal benefits, survivor benefits, you know, if you've had a long-time partner, maybe marriage might make a little bit more sense to take advantage of those strategies. Again, if you're just looking for a tax perspective, they might not be the right person to marry. I don't know. You know, so hey, honey, what do you think? I don't know yet, but I need to save a little bit of money in taxes. Let's go down to the church and get hitched. So here's the three things that you need to do in the next couple of weeks is that you got to set up a donor advised fund, start giving to charity, set up a solo 401k if you are a small business owner, and then get married to someone that has no income. And then boom, right there, you save about 50 grand. That's as easy as that. I don't know what else we can tell you, but that's the tip of the day. All right, we got to take a break. When we get back, we'll get into something that's called a tax-exempt trust. A lot of comments and questions on this tax-exempt trust, and I'll draw it out for you, so don't go anywhere. Show's called Your Money, and it's Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, Big Al Clopine. Thanks for tuning in. Hopefully you're enjoying your day. I know Big Al and I are having a great time talking taxes. Hey, what I want to do, let's get into the true-false question. Al, what do you think?
All right. In order to take the solar energy credit, the system must be installed and operational by year end. And that is absolutely a true statement. So let's explain what that is. If you buy solar energy, solar panels, solar power, for household electricity, as well as heating your water, you actually get a 30% credit. So that's pretty good, right? So you have a $30,000 solar energy bill, to set it up. You get a $9,000 credit, and there's no limit. It could be a $50,000 setup, it could be $80,000 setup, whatever. 30% of that is a tax credit, so that's pretty helpful. But it has to be set up and operational by year end to take it for this year. So you're probably, if you haven't started, you're probably a little bit late. If you have started, try to make sure that it gets completed by year end to get that credit.
So I can't just have it in a box and sitting on the side of my house?
Nope, absolutely not.
It's got to be hooked up, huh?
Yep.
Here, this is what I want to get into real quick. We got a couple of minutes left, and this has been a really interesting and hot topic for a lot of individuals, because if you look at the markets over the last 5 years, they've done very well. Real estate markets, stock markets, and the like. And so now we're back into this game again of saying, hey, I have a highly appreciated asset, but I don't necessarily want to sell it because I don't want to pay the tax. We have a new capital gains tax rate, which is 20% for some of you, plus the new healthcare bill of another 3.8%. Real quickly, let me illustrate. Let's say you have a building, an apartment building, a single family residence that you bought many years ago for maybe $100,000. Today it's worth $1 million. Now, of course, you rented that place out, so you depreciated the house or the property down to zero. So your cost basis is zero. So if you sell it, you have $1 million gain. Okay? So if you sell that, with depreciation recapture, with capital gains, the Medicare tax, state tax, you might lose close to 40% of that asset. So if you go outright and sell it, that's $600,000 that you would net $400,000 gone to taxes. Well, you can set up what is called a tax-exempt trust. You move the property into the trust. The trust is a tax-exempt entity, and it sells that property. This is irrevocable trust, by the way. Once you do this, it's done. However, now you have the $1 million sitting in this trust that now you can create retirement income. So let me ask you a question. Would you rather create income on $600,000, or would you rather create it on $1 million? Of course you would rather create it on $1 million, because you can get a lot more income from that. Here's the caveat. 10% of that asset needs to go to a qualifying charity after you or your spouse's life. Let me ask you a quick question. Would you rather pay 40% in tax or 10% to a charity? I think we know the answer to that question. It's this. So if you want more information, go to purefinancial.com. For Big Al Clopine, I'm Joe Anderson. Thanks so much for watching. You just watched another episode of Your Money is Your Wealth. Have a wonderful, wonderful day.
Do you know what your number is?
You can start doing this. You can find your magic number.
Is your road to retirement mapped out?
One simple mistake could take half of your individual retirement account.
Take advantage of Pure Financial Advisors' decades of experience to help give you a clear picture of where you are. Just by watching Your Money, Your Wealth, you qualify for a free financial assessment. Pure certified financial planners will sit down with you and lay out a personalized assessment of where you are and what you need to do to meet your retirement goals. Go to yourmoneyyourwealth.com or call 1-888-99-GOALS. That's 888-994-6257.
This is the key. Start today.
What you do today impacts how you'll enjoy tomorrow.